Stocks continue to swing on trade headlines. Our next guest says the volatility is creating opportunities to buy. Let's bring in Scott Wren, Senior Global Equity Strategist at Wells Fargo. Scott, great to have you with us.
Hey, Melissa.
When you say this is creating an opportunity to buy, is that impacted in any way by your view of how long it'll take for this trade war to be resolved?
You know, really, we felt like we would see some trade positives over time. I'll have to say that, you know, based on what's happened the last couple of weeks with whether it's Huawei or whether it's just the kind of a temporary breakdown in talks, that time frame's extended out there, and probably the eventual deal that we end up with, maybe it's not as good as the one that we initially anticipated. But I think really for the market to really work its way higher, you know, we don't need the perfect deal. If we get some kind of deal, tariffs go away, the threat of additional tariffs go away, we have a few other things in it. You know, it needs to be more than, yeah, we're going to buy more soybeans and cars, but I think the market would like that. So what we're trying to do, we took some money off the table. We took a little risk out of the portfolios after the big jump after the Christmas Eve low. So in early April, we lightened up a little bit there as far as net exposure, but we're still leaning towards sectors. You know, we like industrials, we like tech, we like consumer discretionary. We stuck our toe in energy after being underweight for, you know, years basically. So, you know, we're leaning in a way toward some upside here, but net, we're a little neutral. I think playing the range, you know, you look down at the 200-day moving average,
right.
You look down a little bit lower than that. I think that's an opportunity if you have the outlook that, hey, we are eventually probably going to get a trade deal and the U.S. economy is not going to fall apart. We'll chug along and you have some, you know, stabilization in the global economy.
Let's say I gave you two scenarios, Scott, and one scenario would be that we resolve this trade war dispute, let's say by the end of this month, and the other scenario is we resolve it in a year and a half or 2 years. Would those sector picks change in either of those scenarios?
I think we'd say, I mean, if the sooner it happens with this trade deal, the quicker we're really going to continue to like those particular sector picks. If it takes longer, year and a half, longer than that, you're going to have a lot of volatility where you are going to, just like you guys have been talking about today, you know, it's the headline of the day. A good headline, like we saw today, takes you higher, gives you a chance to lighten up on those. Bad headlines take you down to technical support. You know, you're either hopefully a little light down there and you're picking up some more cyclical type of things, or you know, you want to hold in and you know, you don't want to take your losses at the technical support levels. So it depends. The longer we go without a trade deal, I think the more murky global growth is going to be, and that's not going to be a good thing for the market or for cyclical sectors.
Hey, Scott, so you sound a bit lukewarm here, and I understand where you're coming from. I'm curious, how does the presidential cycle play into this? Because as I look at it, it seems to me you've got the stock market president who wants to get reelected, will likely do anything to keep stocks higher. Does that fit into your analysis in any place?
Well, you know, we think about that. We're not thinking about it. It's not in the top 5 things that we're thinking about, but certainly we're right on the cusp of just like any presidential cycle where you start to see some things. The incumbent party tries to do some things to continue to boost the economy, continue to make the overall economic environment look good. That usually, you know, is certainly helpful when it comes around to the election time. So I think that's a part of it. But right now, we would say with the Federal Reserve likely off the table here, we're not looking for cuts, and we're certainly not looking for hikes this year or next year. You know, the worry is global growth. The worry is these trade negotiations. And I think that is the key to what this market is going to do over the course of the next 12 to 18 months.
Scott, great to speak with you. Thank you.
Thanks, guys. Go Blues.
Okay. Yeah, why not?
Nice.
A little NHL hockey. What do you think about that, Mel? You going to be watching?
Sure. Yeah, for sure.
Yeah.
What time is that?
Come on.
Okay, so we started the show with saying this is stock picker's paradise. Then we have our friend Scott Wren on, and who's talking about sectors. How should we square this in our portfolio if we're saying it's a stock picker's environment, and yet we're thinking about things in buckets like sectors?
Well, and Scott indicated industrials and tech were some places that they were relatively confident, and yet those are very very cyclical. He talked about energy. I think energy is, believe it or not, somewhat defensive here because for the first time in probably 5 years, the market really is responding to supply disruption dynamics. Obviously, Iran's a big part of that. And frankly, we haven't downgraded at least oil demand that much. So I like the energy call. I still think that the positioning in the sector is underweight. And I believe that the industrials have been overly kind of implicated in this trade war. And I think there's valuations there that are defendable.
So it looks like one of their picks is consumer as well. So within consumer, I think you've got good areas and bad areas. So retail is an example of something that's just completely getting clobbered right now. Whereas you have some like home improvement retailers looking a little better, home builders looking great right now. So there are some areas within each of these sectors that are doing better than others.
So you know what I heard from Scott, though, is that he's saying rotate from sector to sector, right? He's saying don't take your losses at the lows in tech, hold them, and they're going to rally up. Then you might want to sell those. I think that's completely consistent with being a stock picker's market. So if you just take a look at the macro from the top down, you want to pick your sectors and then you pick your stocks in there. And I agree in oil. I would look at like Schlumberger, SLB. That looks like it's bottoming.
Based on the lack of anything financial in terms of what Scott said, I got to tell you something. I actually think that's being forgotten. I think that's going to be an opportunity. And trade has been very, very high. Our volumes in the derivatives markets are off the charts right now.